So thank you everyone for coming along. Tonight we're going to talk about investing in property using your super if you've got the tangible assets in your fund to actually purchase a property. So this is really relating to people who are experiencing some anxiety about capital markets, shares, managed funds, being in industry super funds or retail master trusts. I've personally had a fairly large increase in people wanting to buy a property in response to a lot of the scams that are occurring around superannuation as well. Physical, tangible property obviously comes without the scam factor, given the fact that the owners of the super can go out, pick the property themselves, walk past it, touch it if they so desire, and it's still there. So there's certainly been an uptick in demand, I feel, for self-managed super funds in regards to converting their liquid assets into property. Does come with a couple of challenges that we'll go through, but it's certainly a viable option for those people who are experiencing some anxiety around how their super is invested and getting scammed. So obviously buying a physical property is one of the solutions to that. We could have the next slide. So as I said, I want more money out of paper and into something I can walk up and touch. Obviously talking about real estate. Some of the issues are obviously geopolitical noise. Everyone's aware that at the moment there's a bit of a bun fight over the Strait of Hormuz. A few other issues over in Europe between Ukraine and Russia. There's a lot of press at the moment about potential stock market bubbles around AI and other associated tech companies around the world. So there's obviously aspects of investing in capital markets that create anxiety for many people, most people realistically. So some of the issues you have with paper assets is daily market to market pricing. So if you think about, I go out and I buy a share in the Commonwealth Bank, one share. Commonwealth Bank has turnover of shares in the millions per day. So consequently, that's many transactions within a single day. It's all at auction. So you can imagine if you took the average house in the average street and auctioned it 5,000 or 6,000 times in a day, you would get a very large spread of prices. And that's essentially what happens on stock markets. It's just that because it happens many times every day, what's happening internationally or impacting on that stock, or it's released in the press or stories, creates a lot of volatility around the price. And the larger people's superannuation balances get, the more concerned they get. And obviously the question remains, how do we eliminate that volatility but purchase an asset that will protect us from inflation, which cash can't? High emotional reactivity. One of the big problems with shares is you can sell them very quick. And if someone panics and they sell them quick and the market goes back up, that's obviously a loss. You're vulnerable to, as I said, all of those macro risks of government policy, international trade, inflation, all of those things. Counterparty risks. The reality is with most companies, it's very difficult to know what's happening within them. Many companies can have negative outcomes and large drops in their share prices as a result of the actions of the directors. There's been companies in the last 12 months that have lost as much as half of their value because the founders, who are currently the directors, have got margin loans over the shares. The margin loans get called in. They've then got to sell a massive chunk of the listed share capital to pay out the loan, and down goes the share price. And often very difficult to get clarity on that risk before it happens. And that obviously also leads into panic-driven decision cycles. The classic example of that is the global financial crisis. It was basically a negative feedback loop of declining share prices for a number of years. And that was a crisis in Australia that took our market, I think, just off the top of my head, about 6 years before it got back to the price that it was.
More like 10.
It was. Yeah, I think it
dropped 45% in a day.
Yeah, so it took a long time to recover. Whereas people at that point that were invested in bricks and mortar obviously didn't experience that. Houses get turned over about every, Brendan, correct me if I'm wrong, 5 to 7 years, give or take.
Well, the average person actually 25% of them sell within 2 years, which they shouldn't do. And yes, you're about right. Yeah, 5 to 7 years. Yeah.
Yeah. So
is the average.
Obviously, with turnover being vastly lower, the price then remains much more stable. Property, as we've got listed there, it's a liquid by design. Often, well, certainly at the moment, residential rental property has stable monthly income for no other reason than the fact that it's in a shortage. There's more renters than places to rent, and therefore, your occupancy rates are very high, and the likelihood of you getting the monthly rent that you'd budgeted on is consequently extremely high. There's no daily market noise with property. If I read a negative press about real estate in the suburb I live in, I don't go and sell my house the next day. And so, that creates in itself some stability with prices and value. Real estate's also a tangible asset. It's one of the 3 actual things you can invest in. Real estate, productive enterprise, and mediums of exchange and commodities. So, outside of those 3 things, everything else is a derivative. So if you want to get away,
exchange and commodities, you mean things like precious metals, or?
Yeah, so currency, precious metals, grain, gold, diamonds, something that has a tangible value.
Yep.
Property obviously has a tangible value. There's only a limited amount of it, and therefore people will pay varying prices for it depending on its proximity to the things that people want. Property is also an anchor, a behavioral anchor. If you're experiencing anxiety with other investments you've made, or as is increasingly the case now, 12% super for a couple is creating higher and higher superannuation balances at a younger age, and people are becoming increasingly more concerned about volatility. So when I was 35, my super was worth hardly anything. So a massive daily market shift didn't represent really a life-changing amount of money. Whereas now, if you've got a couple, they might be professionals, have added to their super as well, they could have 600,000-700,000 in their superannuation. If there's a downturn of 5 or 10%, that's obviously $60,000 to $70,000 that they've lost cold. If they had have invested that in property, people are well aware that they don't experience that loss, and that drives this desire for a lot of people to have their superannuation invested in property. We can just go to the next page. So choosing the right vehicle, obviously, if your self-managed super fund can directly own the property, it's a lot easier. Corporate trustee holds the title. There's no additional trust structures that need to be set up. It's obviously a lot cheaper. Ideal for 100% unencumbered purchases. What's becoming increasingly popular is people using lower superannuation balances to pay cash for industrial units or storage sheds. That's becoming a real hot market for superannuation. But Units as well, particularly in regional areas. You can still get units for 400-500 grand. People are buying those. The other advantage of the direct ownership structure, and this is a really big one, it's cleanest for audit. Auditors are happy with it. It's pretty straightforward. It bears very little compliance risk for them because it's a direct asset. They can do a PEXA search on the title. So it's a good structure. The alternatives, as I've carried on about in the past, is obviously the ungeared unit trust structure, where we have insufficient assets in super. It can be useful for a lot of reasons. You could have a self-managed super fund as one of the unit holders, along with some individuals or friends, associates, or other family members in the unit trust become the unit holders. It becomes a pool of assets. It's a means of pooling assets to make something that was otherwise unaffordable attainable. All the assets are allocated proportionately. It's excellent for making sure that everyone is clear about the transparency of the investment. Everything is broken down to by the unit. You receive everything, your remuneration from the unit trust, the number of your units broken down, multiplied by what every other unit got. So it's excellent for transparency. Family trust can be a second unit holder. It's an excellent point. Frankly, I wouldn't be involving family trusts in anything anymore, given the change in the tax legislation. It's possible, it can be done, but the reality is it's going to hurt you tax-wise, so possibly don't do it. You've still got to satisfy all the aspects of the SIS Act, particularly Section 71, and requires an additional trust deed and compliance. But that said, can be a very effective means by pooling resources across multiple individuals and entities to affect a transaction. Some interesting ones we're looking at the moment is where you've got a number of couples that want to buy, say, duplex structure. They've got limited resources in super and themselves individually. A decent duplex development's going to cost somewhere between 1.4 and 1.8. It is a means of doing the whole development in the unit trust, and each party gets one side of the duplex at the end of it, potentially. Works pretty well, keeps it transparent. So if we could go to the next slide.
Yeah, if I can just say, Matt, I've never liked trusts. I think they're, by the general populace, poorly understood about the benefits versus the drawbacks. The ungeared unit trust, though, I think when people properly understand that and what it can offer them in terms of the tax advantages they might perceive that they have lost from SMSF, LRBA, residential borrowing, I'm a huge fan. Yeah.
I raised the duplex structure in a unit trust with multiple people, or a couple of couples or family members or whoever it is. You can go out now and buy a block of land with a house on it that's preferably unlivable or close to it, knock it down. If you build on that property a higher population density or rental density than what was on it previously, that is now available for all of the old CGT negative gearing rules. So that means we could still negative gear and access CGT concessions on a property in an established area with preferential growth aspects to it. So using that means the portion of the property that's held by a super fund or funds is positively geared and the tax managed in the 15% tax environment. Those portions on the outside, as long as any debts or anything like that are not geared against the duplex itself, but against other assets, that can actually be, you can claim negative gearing benefits from that, and it
But how would you do that if it's something that's in an ungeared unit trust that has no borrowing on it? It's going to be positive cash flow. So how would you
the
do
loan? So let's say you've got equity in your house,
that?
and you do an equity release loan to contribute the cash to the unit trust. If that property in the unit trust qualifies for negative gearing and capital gains discount of 50%, that interest on that loan is 100% tax deductible, goes in your tax return. It's a tax deduction.
Yep, as in the interest of the equity release to put in there.
Yeah.
But the actual unit trust itself, that property will be positive cash flow, right?
That's right. But your cash flow is diminished out of the unit trust by depreciation, rental costs, management costs, repairs and maintenance. So it's exactly the same as having a negatively geared property under the old rules.
Okay. And so then the funds that contribute to it other than cash, so equity released out of any other property, even though that in a sense sits outside the UUT, that is claimable.
Absolutely.
Brilliant. But you're eventually going to run out of stuff, because every single time I talk to you, I learn something. Eventually, you won't have any thunder left.
It's true. It'll happen. It won't happen today, but it will happen.
It won't happen overnight, but it will happen.
Yeah, that's what I was looking for. Decorate. Yeah,
there you go.
All right. So, sorry, back to reality. So the liquidity buffer, ATO requires a liquidity of funds at all time of 5 to 10% of the balance. That's monitored and policed by your auditor. If you fall below that, it's a matter of putting a plan in place in which to rectify that and stay above it in future. So that's certainly something to consider as a trustee managing your fund. A bigger consideration is when you hit pension phase, you really want to target a pension payment of 4 to 6%. As a financial planner, when I'm doing pension calculations for our clients, we're often using 7% pension rates as a starting point. Not everyone needs it or wants it, but that's certainly where we kick it off at full retirement. And so it leads back into, I guess, what we talk a lot about, particularly with property and engaging with buyers agents and other professionals in the industry about strategy, is that when we hit 60 and retirement starts to become a real consideration, we need to think about, do we exit the property or do we retain it? And that'll often come down a lot to the property we own. Is it multi-tenancy, high yield? Is it single tenancy, low yield? Do we start the pension first? Because if we've bought the property outright, or we've bought it in a unit trust and our super fund slowly bought all of our units off us, so all the units in the unit trust are now owned by the self-managed super fund, it now sits 100% within a super fund. We ideally will start a pension to be paid from that fund before we sell the property, because as soon as we receive a pension payment, our self-managed super fund is 100% tax-free. There is no tax to be paid of any kind in that fund ever again. So it's a really effective, it's a really important part of strategy. If we're talking to people who are in the situation such as myself in their 50s, we probably want to have that property owned 100% by our super fund by the time we hit 60. And then we've then got the option to sell that property and pay no capital gains tax at all, even though we've potentially, through unit trust, claimed the deductions on it as we went. So that's a really important factor to consider.
Matt, question. So confusion always comes up about 60 versus 65 and that your pathway to retirement kind of legislation. So
I can explain that emphatically. No problem. You have access to your super fund whether you retire or continue to work at age 60. 65 is creating a lot of confusion because it used to be the age at which you qualified for the age pension. 65 is now irrelevant because most people now qualify for the age pension at 67. So they're the two numbers. But importantly, just to make it even more complicated, meet the work test, you can potentially still contribute to super throughout your life and make non-concessional contributions up to age 75. But that's a long-winded, complicated conversation that I think would be best. That's another whole series, pension planning. But
that sounds awesome. Can I sign up for that?
Yeah. That'll be really. That's really going to bring him in. That's super interesting.
I'm getting turned on. That's great.
Yeah. I'll bet. But look, the bottom line, I guess, for all of us, where we're talking about property investment and using self-managed super funds, the date that is really of most importance is that when the members of that fund turn 60, because that should really factor in to the planning and strategy that we're doing. I've got plenty of clients whose unit trusts won't be owned fully by their SMSF until they're probably 67 or later. They're quite happy with that. They're continuing to work. They have no real great ambition to slow down at this point in time. So that suits them. I've got other clients, the day they hit 60, they came in my door, started a pension and walked up the street to the real estate agent. So, it's just a part of the conversation to have.
But then the trigger point is hitting 60 in order to sell assets CGT free. They don't necessarily need to have started a pension to avail that.
To sell it CGT free, you've got to start that pension.
Okay.
Do not sell that asset until a pension payment has been made from the fund to the members.
That's important. And then is there a percentage of the fund that needs to have been paid as a pension in order to take advantage of that?
It's a single payment. So pensions will have a minimum payout that's got to be made to ensure that 100% of the assets of the fund are considered in pension phase. So you need both, if it's a 2-member fund, both members need to be over 60. Then you start a pension. There'll be minimum amounts depending on what's in there, how old both of them are. You're just going to basically pay out, if it's 10 grand each, you need to pay out, say, righto, monthly pension. Sorry, if it's 12,000 each, monthly pension is $1,000. Pay $1,000 out to each of them. That pension is started. So that property can then be sold CGT free.
Even if the pension wasn't to continue and they've just done the first month payment. Hypothetically.
That would create an audit issue.
Sure. Okay. Understood.
Because the pension would represent less than, it'd be more of an issue about the pension not being complying, and then that would ultimately you potentially wouldn't get the CGT discount.
All right. So you're best to just continue the minimum pension.
You want to pay the pension for that year at least.
Sure. Okay. Understood.
Yeah. If we could have the next slide. Okay. So what makes a compliant tangible asset? So for residential, obviously we've got lower entry costs, lots of tenants, simple ongoing management. It's pretty straightforward. Commercial is a little bit more complicated. It does carry a higher yield, obviously. Longer lease terms. So once you get a tenant in there, they tend to be in there for quite a while. You also don't have, your tenant usually pays your outgoings, but not always. You can lease it to yourself from your super fund. So that's really important for business people buying a business premise. But deeper due diligence is required. So avoid traps of, you can't rent a residential property to yourself. Doesn't matter if it's in a unit trust of the super fund, just don't go there. Can't be personal use. Just don't buy holiday homes in super. Full stop. Just don't do it.
Yeah.
If you don't buy an Airbnb or a holiday home or something like that in your super fund, members and associates and relatives can't use it, and therefore you can't have a problem. So just run down that track is my advice in that regard. That feeds into the sole purpose test. Sole purpose test is that the investments of the fund are for the provision of retirement pensions, which obviously if you buy a beach house on the coast somewhere at a lovely spot and it gets minimal rent all year except for the 3 weeks over Christmas, it's clearly the decision was made not with the consideration to providing pensions, but a holiday home.
Once you though hit 60 and you're in retirement, then that could be potentially
those rules are always there is
permanent.
no exception.
So you would have to sell it to yourself personally and trigger stamp duty again.
Yeah.
Yeah. Okay. Cool.
So target profile, low vacancy, high land value, and proven growth corridor, always an important one.
I think an important point there, Matt, is what we were just discussing some days back, that you can room let as long as you're not getting a personal benefit out of it, but to increase the rental income of an investment property bought there, you can lease the rooms individually.
Yes, absolutely. So, boarding houses, that kind of thing, are an allowable asset. Yep. We can have the last slide, please. Next slide. Yep. So transitioning from liquid assets into property, you want to make sure you know what the capital gains tax position is of the assets that you're selling, because there will be a tax liability, hopefully, if your investing has been successful. So you want to know what that cost is, because that's unavoidable. You want to know how to structure your cash pool between your super fund, your unit trust, and externally. You want to know how much you can afford to buy, what liquid assets you need to retain in order for the fund to remain compliant. With every property transaction with a super fund, I can't remember how many transactions I've done, but it's a few. I check what the names need to be on the contracts every single time. It's just not worth paying double stamp duty. And property management, always a great idea to get a licensed property manager. They're usually in a real estate agency as well, and it makes life a lot more pleasant when it comes around to audit time to get a rental statement from a professional to hand to the auditor rather than highlighted lines on the bank statement. It also means that you can engage a licensed real estate agent to give you a market appraisal every couple of years rather than engaging a qualified valuer, which is a cost saving, but also it's a lot faster. It's a lot easier. So,
can I just ask about the first one? Are you talking about when you're in retirement or during working years?
During working year, the fund's got to maintain a level of liquidity at all times, even before retirement. So, you need at least 5% as absolute bare minimum of the fund assets.
But you're talking about staging the sale across 2 to 3 years? The first one?
Yeah, so let's say you've got a portfolio of managed funds in your superannuation fund, and you want to liquidate everything and buy a property. If there's substantial capital gains tax liability within that fund, the ideal would be to sell, hypothetically, half of it in June, so it falls in one financial year, and the balance in July, so it falls in the other financial year. It spreads out the cost from one year to the other of capital gains tax liability. You're still going to pay it, just spreads it out.
But I mean, the actual total amount at 10% after 1 year is going to be the same, right?
Absolutely.
So it's kind of academic.
But you think about it. Let's say you liquidate a portfolio today, and there's $100,000 capital gain in it, so that's 10 grand in tax payable. Yep. That fund doesn't have to lodge that return and hence pay that tax until March 28. So you've got 18 months to accumulate the capital to pay the tax bill, as opposed to if we'd done it in June, it's going to have to be paid in September or October of this year.
Yeah, okay, because you're given like 3 months after the end of each financial year.
Yeah.
Okay, good point.
Yeah. Okay, next slide. Okay, so essentially what we're talking about, market weary investor. They've got a super balance of 750 grand. It's all in equities and managed funds, which most superannuation is. They've become tired with market downturns or volatility. So first, we would sell down a portion of the portfolio, freeing up sufficient capital to buy a property. In this case, we're arguing, it's 550 grand, keeping 50K as a liquid buffer. We go out and purchase tradie unit, storage units, small unit, residential unit potentially for 500 grand. We've got no debt. We no longer have to worry about market fluctuations, particularly with a residential unit. We're almost certainly assured of rental income. So, all of a sudden you have eliminated the anxiety of the market fluctuations around your superannuation. Can we have the next slide, please? So the big one, as I've said, having done this for some time, one of the biggest motivators for people wanting to invest in property or use their super to invest in property is market volatility with shares and equities and managed funds. People lack a sense of control and safety from that. Whereas I think the average person buying a property with their super derives a great deal of certainty and security and ease from buying property or transitioning from shares and managed funds to property. As we said, we can do it directly or through unit trusts, as long as we do it in accordance with the rules and finally maintain the appropriate liquidity structures. So that's it.
I don't know how industry super is still going.
Look, there's
the biggest false economy joke ever.
Look, I wouldn't like to say that in public forum.
Well, come on. People would think they've got a good return when it's 10%. You take away management fees and then it sits them at 8 or 9. And that doesn't account for the fact that then, that's right, it dropped by 45%, then took 10 years to recover. And then you have something like COVID hit and 10, 20, 30% drops. So you have an accountant or a financial planner like yourself, not specifically you, but that category of people going, but you're doing it for the long term, mate. Okay, well, hang on for years and I can't retire now. I think it's just so damn obvious.
Look, I think for as much as there is a cohort of the population that derives a great deal of security and ease from investing in property and using their super to do that, there's equally, if not more substantially, a cohort of the population that derives a sense of security and ease from being invested in a way that a lot of other people are. And that's what the industry super funds offer. The other thing they offer is diversity. So industry super funds in particular, they're very large. Australian Super is an excellent example. You're talking many, many billions of dollars. They are able to invest in ways institutionally that you just can't as an individual. No one has that kind of money. So it's a philosophical difference. You're a buyer's agent, real estate professional. It's understandable that you feel the way you do about industry super and retail master trusts and managed funds and shares. And there's plenty of people who obviously are your clients that feel the same way, and there's nothing wrong with that. But
I've actually that thing I've ever told you, Matt, I was a financial planner. So I used to look at
unaware.
I used to look at these graphs and pie charts and stuff and try to explain them to clients in a way that made them feel better about doing so poorly. So I know I always will come across as biased because I'm very property focused, but I just try to judge things by maths.
Look, I don't think, I wouldn't term it as biased. I just think there's a diversity of cohorts of people in the population. And there are people out there that industry super fund or retail master trust is undoubtedly the best place for their super to be. They don't want to think about it. They'd like to just know what's in there when they hit 60, and that's it.
Yeah.
And,
Well, I mean,
they just need to know that their super guarantee is being paid in by their employer. And that's all they want to know about. There's another cohort. I have clients with self-managed super funds that have no asset other than term deposits. They wanted to control the term deposits. They just want it all in cash. And
is their median age about 7,000 years old?
Some of them getting on. Some of them are getting on.
A touch conservative.
Yeah. But, that said, as an accountant and, SMSF person, most of the funds that we look after do have some exposure to direct property. That was the whole purpose of starting them in the first place. It's a feasible reason to open a self-managed super fund. It's, why are you opening it? Because I can't buy direct property in other superannuation structures. Ours there, no problem. People make these decisions for themselves. There's plenty of people out there that don't want to make those decisions for themselves.
I think there's a little bit of a misunderstanding as well. Like a lot of people not realizing that the 80%, the end of 80 and 90% borrowing on Monday is for residential, but you can borrow up to 80%. 60 to 80% is probably the range for commercial and industrial property.
In super, absolutely. The LRBA is still available. It's just not on residential property.
Yep.
So
God bless the Labor Party, aren't they great?
Once again, public forum.
They're wonderful.
Not going there.
I just said they're wonderful.
Well, I wouldn't like to say one way or the other. We'd leave that up to, the ABC and Politics Now with, PK and
the next election.
Kelly. Look, it'll be interesting. There's obviously those people. There's obviously some economists that feel pretty strongly that the budget was done fairly well. There's obviously a lot of cohorts in the population that feel that they're pretty annoyed about it. And it comes down to philosophy. I think, those people are unhappy about it are aspirational people who would like tomorrow to be looking a little rosier than what it was yesterday.
What a concept.
Whereas obviously there's a cohort that feel that, equality across the spectrum of people in our economy needed to be addressed, and that's exactly what they've done, for better or for worse.
Sounds slightly communist, yeah.
Yeah, that's not going to come into the podcast.
No, that's fine. I'm just making an observation on what you said. Can I just finish on a more serious note? Like in my lifetime, I'm a bit younger than you, but the GFC was when the most most market example was obviously the GFC.
Yeah.
Which wasn't even really our fault. It was America's fault. But that's when it really bit, and then took a good 10 years to recover all ordinaries, and then COVID dropped it all again. But prior to that, people often forget the .com boom, first, and also the Asian financial crisis.
Yes.
So those are four major crises that have had a direct impact on the ASX and on confidence levels. So it's very sentiment driven. And so, as you call them, paper assets, well, it's because they are. There's nothing actually tangible underneath them. There's business operations, but then that's a subjective view of a fundamental or a technical analysis of what that is worth to that operation. But there's nothing actually physically like bricks and mortar there.
It's certainly a more complicated situation to us. So if you exchange traded funds on the stock exchange now are very popular. Lots of good reasons. You can go out and invest in an exchange traded fund that has a balanced risk profile, similar to what you would get in a retail master trust or industry super fund. For the average individual to sit back and assess the intrinsic value of what the assets are laying behind that ETF is enormously difficult. It might have, if it's an index fund, it could have several hundred investments, all bought at different times, all with different cost bases. It would be enormously difficult to assess the intrinsic value of it.
Well, that gentleman that attended, I think, your first one in this series, Nicholas CEO, remember him?
Yep.
Yeah. I'm sure he won't mind me saying he's got in the millions of ETFs and thinks they're the best thing since sliced bread. And of course, I beg to differ on that point. I was like,
Sure.
he tried to do some maths with him and didn't seem to go very far. But I mean, he's a very bright guy. He certainly knows his stuff. He's very mathematical about his approach, and it just happens to be his strategy. So I mean, I hear you. Everyone's horses for courses. I get it, but at the end of the day, maths wins, really.
Yeah, absolutely.
Should.
Yeah.
Anyhow.
So, gentlemen, thank you. Everyone that's listening.